Most people think rich people become richer by buying more things, more houses, more land, more luxury property, more assets. That's the image most people carry in their head. When someone becomes wealthy, we assume they collect physical symbols of wealth: bigger homes, vacation properties, luxury cars, art collections, commercial buildings. But something unusual has been happening quietly over the last few years. Some of the wealthiest people in the world have started doing the opposite. They're selling physical assets and moving aggressively toward liquid cash. Not because they suddenly became poor, not because they stopped believing in investing, but because people at the top often react to financial danger before the public even notices it exists. And when large amounts of smart money start prioritizing liquidity over ownership, it usually means they see instability coming. Not necessarily a crash tomorrow morning, but pressure, volatility, uncertainty, the kind of environment where flexibility becomes more valuable than appearances. Because during stable economic periods, owning physical assets feels powerful, but during unstable periods, liquidity becomes survival. And most middle-class people never fully understand this shift because they've been taught one financial lesson their entire life. Own more, buy property, buy assets. Never sit on cash. Cash loses value to inflation. That advice sounds intelligent during growth cycles. But wealthy people know something important. Every financial strategy works differently depending on the environment. And right now, many wealthy investors believe the environment is changing. Take a realistic example. Imagine someone worth $40 million. Most people assume that means they have $40 million sitting in a bank account somewhere. Usually they don't. A large portion of wealthy people's net worth is tied up inside assets: commercial real estate, private businesses, equity stakes, luxury property, investment portfolios, collectibles, land. The problem is that physical assets are not liquid, and liquidity matters enormously during economic stress, because an asset can be valuable on paper while becoming extremely difficult to sell quickly. That distinction becomes critical during unstable markets. A person may technically own $20 million worth of real estate, but if buyers disappear, financing tightens, or markets weaken, that value becomes theoretical. And wealthy people understand theoretical wealth is not the same thing as usable money. That's why liquidity becomes attractive during uncertainty. Cash creates optionality, and optionality is one of the most powerful forms of financial protection. Let's simplify this further. Imagine two wealthy individuals. Person A owns 5 commercial properties worth $15 million total, but most of the value is trapped inside buildings. Maintenance costs continue, taxes continue, insurance continues, and if the market weakens, selling quickly may require massive discounts. Person B sold several properties early. Now they hold large cash reserves, treasury positions, short-term liquid investments, lower debt exposure, less overhead, less stress. Who survives instability more comfortably? Usually the person with flexibility. And flexibility comes from liquidity. This becomes even more important when interest rates remain high, because high interest rates quietly change the behavior of the entire economy. Consumers spend less, businesses borrow less, real estate activity slows, investments become harder to finance, asset prices experience pressure, and suddenly assets that looked unstoppable during cheap money years begin behaving very differently. This is why many wealthy investors started reducing exposure to physical assets after years of aggressive expansion, especially commercial real estate, office buildings, retail spaces. Luxury developments. Some sectors became dangerously dependent on cheap debt and constant growth, but cheap debt is disappearing, and growth is slowing in many parts of the economy. Now combine that with another major problem. Modern markets are becoming increasingly unpredictable. Geopolitical tension, supply chain instability, persistent inflation pressure, AI disruption, banking concerns, consumer debt growth, housing affordability problems, government debt expansion. All of this increases uncertainty, and uncertainty changes investor psychology. During stable periods, people chase maximum returns. During unstable periods, people prioritize protection. That psychological shift matters a lot, because most financial bubbles are fueled by confidence, and confidence can disappear very quickly, especially when leverage is involved. The wealthy understand leverage better than most people do. Because leverage creates two different realities. In good times, leverage accelerates wealth. In bad times, leverage accelerates destruction. And many physical assets are deeply tied to leverage, especially real estate. A luxury property purchased with cheap financing can look brilliant during rising markets. But if rates rise, buyers weaken, and holding costs increase, that same property becomes a financial burden very quickly. This is why liquidity becomes emotionally comforting during uncertain environments. Cash reduces pressure. You can survive longer, wait longer, negotiate better, move faster. That last point matters enormously, because downturns often create the best buying opportunities, but only for people who still have liquidity available. This is one reason many wealthy investors quietly accumulate cash before major market dislocations, not because they stop believing in investing. Because they want dry powder. They want the ability to buy valuable assets later at discounted prices. Average investors usually do the opposite. They become fully invested near market peaks, emotionally confident, highly leveraged. Then panic arrives, liquidity disappears, fear increases, and suddenly they're forced to sell assets at the worst possible moment. Wealthy investors try to avoid forced decisions. That's the key difference. Forced financial decisions destroy wealth. Liquidity reduces forced decisions. And this principle applies far beyond billionaires. It applies to normal people too. Think about how financially fragile many households became after 2020. People bought larger homes, more expensive cars. Lifestyle inflation accelerated rapidly. Monthly payments exploded. And much of it happened during a period of artificially cheap money. Now interest rates are higher. Insurance costs increased, property taxes increased, consumer debt increased, layoffs increased, and many households quietly discovered something uncomfortable. Owning expensive physical assets can create enormous pressure when cash flow weakens. A person may own a beautiful home, luxury furniture, a financed SUV, expensive watches, designer products, but still feel financially trapped every month. Because asset-heavy lifestyles often reduce liquidity dramatically, and reduced liquidity creates fragility. This is where many middle-class people misunderstand wealth completely. They assume visible ownership equals financial strength. Sometimes it does. Sometimes it absolutely doesn't. Some people look wealthy but are heavily leveraged behind the scenes. Others look modest but hold enormous liquidity and investment flexibility. And during unstable economies, the second position is often much safer. The wealthy understand this deeply, which is why many prioritize preserving capital during uncertain periods instead of maximizing appearance. This also explains why some high net worth individuals suddenly start selling secondary properties during uncertain environments. Not necessarily because they need money immediately, because they want optionality. A vacation home sounds attractive during stable periods. But during uncertainty, that same property becomes another expense, another maintenance obligation, another tax bill, another illiquid asset, another thing requiring attention. And the wealthier someone becomes, the more they begin valuing simplicity. That surprises many people. Middle-class culture often associates wealth with accumulation, but truly wealthy people often become obsessed with efficiency. Reducing unnecessary complexity, reducing exposure, reducing maintenance, reducing obligations, especially later in economic cycles. Because sophisticated investors know one painful truth. Market conditions eventually change. Always. Every major financial cycle in history eventually reverses. Cheap money periods end. Speculative bubbles cool. Overpriced assets correct. Consumer behavior shifts, and liquidity suddenly becomes extremely valuable again. This happened during 2008, it happened during the early pandemic panic, it happened during multiple banking crises, and each time the people with liquidity gained enormous advantages, while others became trapped. That word matters. Trapped. Because illiquid assets can psychologically trap people during unstable periods. You can't move quickly. You can't adapt quickly. You can't reposition easily. You become dependent on market conditions staying favorable. And wealthy investors hate dependency, especially dependency on unstable markets. Now, to be clear, this does not mean physical assets are bad. That would be shallow analysis. Physical assets can absolutely create enormous long-term wealth. Real estate built many fortunes. Businesses built many fortunes. Land ownership built many fortunes. But timing matters. Debt structure matters, liquidity ratios matter, cash flow matters, economic cycles matter, and wealthy investors constantly adjust their strategy depending on changing conditions. That's the part average people rarely see. The public often imagines wealthy people as permanently aggressive investors constantly buying more assets. In reality, sophisticated investors constantly shift between offense and defense. Sometimes they become aggressive. Sometimes they become cautious. Sometimes survival matters more than expansion. And right now, many wealthy individuals appear to be prioritizing flexibility over expansion, especially after years of asset inflation. Because when asset prices rise too quickly for too long, smart money starts asking uncomfortable questions. How sustainable is this? What happens if credit tightens? What happens if unemployment rises? What happens if consumers pull back? What happens if refinancing becomes difficult? What happens if liquidity dries up? Average investors often ignore those questions during bull markets. The wealthy usually don't. That's why they often look paranoid near market peaks and intelligent near market crashes. Because preserving wealth requires different psychology than building wealth. Building wealth often requires aggression. Preserving wealth requires caution. And many wealthy people today are in preservation mode. That doesn't mean total collapse is guaranteed, but it does suggest elevated caution among sophisticated investors. And honestly, some of the signals are understandable. Global debt levels remain extremely high. Housing affordability remains strained. Commercial real estate pressure continues. Consumers increasingly rely on debt. Many economies are slowing, and artificial intelligence is creating enormous uncertainty around future labor markets. Nobody fully understands how these forces will interact long term. That uncertainty alone increases the value of liquidity, because liquidity gives you time to wait, time to adapt, time to survive mistakes, time to identify opportunities, and time is incredibly valuable during unstable economies. This is another reason wealthy investors often avoid emotional attachment to physical assets. Average people sometimes treat assets emotionally. My dream house, my forever property, my identity. Sophisticated investors usually think differently. They ask, is this asset still serving my financial goals efficiently? That mindset changes everything. Because once assets stop being emotional symbols, decisions become more rational. Selling becomes easier. Reducing exposure becomes easier. Protecting liquidity becomes easier. And emotionally detached decision-making is one of the biggest advantages sophisticated investors have over average investors. Most people buy emotionally. The wealthy often sell emotionally detached. That difference matters enormously during uncertain environments. Especially because modern economies move faster than ever now. Industries shift rapidly. Technology changes rapidly. Consumer behavior changes rapidly. Entire sectors can weaken unexpectedly. And the people most likely to survive those shifts are often not the people with the largest visible wealth. They're the people with the strongest financial flexibility. This is why cash should not always be viewed as doing nothing. Sometimes cash is strategic patience. Sometimes cash is defensive positioning. Sometimes cash is future opportunity. And sometimes cash is psychological stability. Because financial stress changes behavior. People under pressure make worse decisions. Liquidity reduces pressure. That's one of the most underrated financial advantages in existence. The ability to think clearly during uncertainty. Many wealthy investors understand that survival itself is a competitive advantage. If you survive downturns comfortably while others panic, opportunities eventually appear. Discounted assets appear. Distressed sellers appear. New investments appear. But only people with liquidity can move aggressively during those moments. Everyone else is too busy surviving. That's why some of the wealthiest people in the world become extremely defensive before the public fully understands the risk environment. Not because they know the future perfectly. Nobody does. Because they understand cycles, and they understand human behavior during stress. They know confidence can reverse quickly, credit can tighten quickly, asset values can change quickly, liquidity can disappear quickly. So they prepare early, quietly, without dramatic headlines, without panic. And that preparation often looks strange from the outside. People see wealthy investors selling physical assets and assume something must be wrong. Sometimes something is wrong. Sometimes they're simply becoming cautious earlier than everyone else. That distinction matters, Because the wealthy are not always trying to maximize returns. Sometimes they're trying to maximize survival probability. And survival is what allows long-term wealth to continue compounding over decades. This is the part many people miss entirely. The goal of wealth is not constant expansion forever. The goal is durability, the ability to survive multiple economic cycles without catastrophic damage. And durability often requires liquidity, especially now. So when you hear that wealthy investors are selling physical assets for cash, don't immediately assume they lost faith in investing. Look deeper. They may simply believe flexibility is becoming more valuable than ownership. And in unstable economies, that belief can become extremely profitable later, because the people holding liquidity during panic are usually the people buying the future afterward. Before you leave, remember this. Wealth is not just about how much you own. It's about how much pressure your financial life can survive. If this video changed the way you think about money, hit subscribe, because modern finance is changing fast, and understanding these shifts early can protect you from very expensive mistakes later.